welcome back to the Self-Wealth Real Estate Podcast. Today we have a very special episode. Now, I'm very fortunate that my brother, Marc Boiron, happens to be a leader in the cryptocurrency space. Now, I'm not a crypto guy. I'm a real estate guy through and through. I bleed lath and plaster and knob and tube. But I happen to be very fortunate that my brother is one of the best in the world at blockchain technology and crypto. Now, he did a law degree and an MBA. He became a lawyer, worked at a national firm as a partner, specializing in blockchain and crypto, and eventually moved in-house at a crypto company as their chief legal officer, moved to another crypto company as their chief legal officer. That's Polygon Labs. And he is now, for about a year now, he is their chief executive officer, their CEO. So Polygon is if you value their crypto-matic, it's $1 billion, a $10 billion company. And he, my brother, is their CEO. So this guy is the utmost expert, and I'm not. I know very little about crypto, just what I see on social media and stuff like that. And I focus on my space and what I do well, which is real estate. However, since I have access to one of the world's utmost experts, I wanted to do an episode on what am I missing? What do I not know about? What should real estate people know about crypto? And that's what this episode is about today. So Marc is giving us a bit of an intro on cryptocurrency. We talk about Bitcoin, Ethereum, and other cryptocurrencies, what their uses are, what their uses aren't. And I think this is a really interesting episode. Whether you want to switch from real estate to crypto or not, I think this is a really interesting episode to kind of understand crypto better, understand how it could be useful, whether you decide to move fully into crypto or not. That's not what this episode is about, but more about where it is useful and how it could be useful in the future. So if you have any curiosity about cryptocurrency, this is going to be an excellent episode for you. And I believe for people who know a good amount about crypto as well, because Marc is such an expert and speaks so well on the topic. So thank you very much for listening, and let's jump right in. So today is a very special episode of the podcast, as I have already introduced my brother, Marc Boiron. Marc, welcome to the show.
Hey, Luke. Thanks for having me.
So today's going to be a little different because my brother happens to be one of the top people in the crypto world, and I am a real estate person, and I know very little about crypto, blockchain, Bitcoin, all of that. So I thought this would be a really helpful episode for us to discuss how real estate people can use crypto, or if they should, and what they should be paying attention to. So I really think this will be, we're speaking, Marc, to people like me who know real estate, love real estate, learn about real estate, and yet have not had the opportunity to explore crypto world and blockchain and what that can entail. So can you give me your background first? What did you do before you got into the position you're in now?
Sure. I'm always excited to talk to real estate people about crypto because we all have very different perspectives on things. So I'm a securities lawyer by background. Was a lawyer for a while, working on different securities law related issues. And then back in 2017, learned about crypto and loved it, thought it was super interesting, and there'd be great opportunities there. And so I got into crypto. And since then, I have been in the space. And back in about 2021, I moved on from a law firm to going in-house to be the chief legal officer at a crypto company. Then I moved on from there to the current company that I'm at Polygon Labs. And I was the chief legal officer. And then about a year ago, the team asked me to take over as CEO. And I have been the CEO here since then.
Okay. And since I'm not in the crypto space, Polygon Labs, it's a little startup in the crypto space, I guess.
So Polygon Labs, and it has a long history. We started back in 2018, and keeping things like relatively basic. People have probably heard of like one crypto for sure, which is Bitcoin, and then most have generally heard about a second one that we refer to as Ether, or people say Ethereum. And without getting into like the details, the problem with a lot of blockchains is that they're slow and expensive. And there's reasons for this that aren't too relevant here. But what we do at Polygon is we help those networks actually get faster and cheaper. And the way we did that at Polygon when we started out was we created a new network called Polygon Proof of Stake. And there is a token associated with this, a cryptocurrency known as Matic, that is very well known. I think we were up to 550 employees at one point during the last bull market. Crypto has very kind of big ups and downs. We're currently at about 250 employees right now. And we're really just working on continuing to help Ethereum get faster and cheaper.
Okay. And what's the market value of Polygon Labs, the market cap?
So crypto's kind of special in this sense in that Polygon Labs is actually a nonprofit. We don't actually have any equity. There is no value of Polygon Labs. The Matic cryptocurrency is about a $10 billion cryptocurrency market cap. And that's kind of what most people look at.
Okay. Very interesting. For those listening, we typically talk about a lot of real estate, which works in a lot of different ways in different areas. Specifically, just wanted to say that Marc is in the US. So any kind of legal framework that he's going to be talking about in regards to any of this is going to be US based. So just wanted to refer to that. And obviously, we're talking 10 billion US dollars. So very small startup. Clearly, doing something wrong. Clearly, he's the brother who's failed in life. And but I'm very happy to have you on, So
I feel the same way.
Thanks. All right. So clearly, Polygon, proof of stake, Matic, you guys are providing, kind of filling in voids that were in the market that weren't there. And you guys are providing something useful that helps. Tell me more about what Polygon does and why its products are helpful.
Yeah.
Or why the
maybe what's useful so that people have more context. Maybe we back up to the origins of crypto and talk about Bitcoin a little. Does that work for you?
Yes.
Okay, cool. So why was Bitcoin created? Because a lot of people think of this as magic internet money, which is true. And people think of it as something that's not actually all that useful, which I think is probably untrue. So if you go back to why Bitcoin was ever created, it's simply because historically money has always existed and been in the control of a government. And that government gets to do whatever they want with that money. And we see this when they decide to print more money, for example. And so somebody named Satoshi, unknown to everyone, decided, I'm going to create a type of money that is outside of the control of any government. But to do that, you needed new technology. You needed a technology that was not in his control. If he controlled it, he would just be the new government. That wouldn't really be really helpful. Instead, what he decided to do is, I'm going to create what we refer to as a blockchain network. And in doing that, what I'm going to do is I'm going to make sure that everybody, through consensus, has control over this money. And what does that look like? Effectively, what it looks like is you might have heard of miners. There's these computers that are essentially all running the Bitcoin software. It's basically just a software. It all exists in the internet, right? And every time somebody is running this software, they basically have a copy of the entire Bitcoin history. And so if Satoshi, who created Bitcoin, says, I want to turn off Bitcoin and take all the money, Satoshi could not do that because Satoshi only has one copy of the Bitcoin network. There are now, I believe, there's maybe 10,000 to 20,000 different computers running that we refer to as nodes, maybe even more, maybe it's 100,000, I don't know. There's a lot that are running these nodes of Bitcoin, which basically means that once Bitcoin got to the size that it's at now, and even the size that it was back in 2017, there was an understanding that you could not stop this thing. It doesn't matter what you do. Government can try to stop Bitcoin. And unless every government in every country can collectively do that at once, the Bitcoin network's going to continue to exist. And one of the ways that it did that is by ensuring that people could not double spend money. And basically the idea was that Bitcoin ensures that if you want to spend any of the Bitcoin that you have, that there needs to actually, there's a confirmation that you actually have that Bitcoin before you want to spend it. That's one of the things that's like special about kind of blockchain networks and including like the consensus mechanism to come to agreement on it. So once that gets created, now what you have is you have this independent form of money that can be used by anyone and that really can't be stopped by any government. The question is like, why would you use this money? And if you're sitting in the US or in Canada, even today, you would reach the conclusion that you have absolutely no reason to use Bitcoin to send money to somebody else within your own country. And that is abundantly clear by the fact that like we can just use a credit card or a debit card and pay for something, and it's not that useful. But if you go beyond Canada and the US, you start realizing maybe that's not actually true. Maybe not every country has the same payment mechanisms that you have there, and they don't actually have a good way to pay. And they'd rather actually have this network that is not in the control of their government, does not require their government building good infrastructure. It just requires this network to continue to exist with at least one person, and right now, thousands and thousands, running these nodes so that the network can continue to operate. And that gives you a lot more confidence in your ability to pay. But there's two things that we're missing when we look at that analysis only in that way. First, it's not actually true that I don't have use for Bitcoin. I remember back in 2017, I wanted to pay for something over the Christmas holidays. And this is not a joke, by the way, like literally tried to be. And I went and I wanted to create a transfer, and banks were closed, couldn't do a wire. I think an ACH, so just a bank-to-bank transfer, was going to take something like 5 days at the time. And I was like, this is insane. And I really needed to transfer, and I can't remember anymore why, but I literally just went to my Bitcoin wallet and I just transferred Bitcoin to this person that I needed to pay. And that's like in the most, one of the most advanced countries in the world, I faced that issue. Now, imagine the exact same thing, except I'm sitting in the US and I have family members in Mexico who really want me to send them money on a continuous basis every month. This is like a common thing, or anyone who wants to do cross-border payments. You're generally going to pay pretty significant fees with pretty significant delays, and I can just send you Bitcoin immediately, and you're holding Bitcoin now. There is zero doubt that Bitcoin solves, and other cryptocurrencies solve, cross-border payments in a way that literally cannot be solved by current banking systems at all. The last,
so let me ask you a question about.
Go ahead.
We'll come back. But cross-border payments. What's the cost? Let's say I want to, I don't know, you're in the US, you want to send me $100,000 and I'm going to receive it equivalent of Bitcoin, and I'm going to receive it in my Bitcoin wallet that doesn't exist yet. Now, what's the cost of that going to be if I then want to, cash that from Bitcoin to Canadian dollars? What are the transfer fees? How does that work?
Yeah. I mean, when you send Bitcoin, you pay a fee to the network. And that fee does depend on how much the network's being used. But you're talking about a couple dollars, almost not. And by the way, we're focusing on Bitcoin. Like, there are networks right now, if you were to send that exact same transaction on Polygon proof of stake network, you would pay half a cent. And you could be you could be sending $1 billion, or you could be sending $1. It's going to cost you half a cent. It doesn't matter
terms of
the size.
Changing it into currency, is there cost there? Like, let's say, so, I mean, obviously comparing this, I recently received some US dollars, had to convert them to Canadian. I received them in a US dollar bank account in Canada, and then I had to convert them to Canadian dollars. And it was enough money that it was worthwhile taking a look at the cost of the exchange rate. And in fact, I ended up, negotiating the rate with the currency desk of the bank. I guess, so, you have your posted rate, let's say 1.3500, whatever. That's the posted market rate. But when you go to the bank, they might not give you 1.3500, they might give you 1.3402 or something like that, right? Or 3.20. Yeah. So you're going to lose a little bit on the exchange. And obviously it goes the other way as well. So the bank makes their spread on the other side. how does this work in terms of, let's just keep it at Bitcoin or Matic, Polygon's proof of stake?
Yeah, I think it's the answer is there's exchanges who will exchange your cryptocurrency for cash. What they charge, it depends on volumes, it depends on a lot of things. But frankly, like the most expensive ones, like Coinbase, probably charge you 1%. And when you're like a bigger customer, they charge you probably 0.1% or something of that nature. But the key thing is there's like a big assumption that's made here, which is that we're going to move into a world where you don't need to convert into cash. Actually, I will go so far as to say I know at least a dozen people who live off of Bitcoin. They never touch cash, like never. They get paid for services in cash. They buy groceries in cash. They buy their vacations in cash. In Bitcoin. In Bitcoin. They do it all in Bitcoin. And they never actually touch cash. And they're doing it obviously because there's more purposes to it than just that. Like they want to do it because they philosophically believe that that's the right thing to do. They're anarchists, and so that's what they believe. But the point is, you can do it. And so, like when you look at those fees, the answer is like, okay, that's not the long term necessary like result. I will say because you're asking this question specifically, there are other things that you could do. We're using Bitcoin because it's the first one to the example. There's a cryptocurrency called USDC, the US dollar coin. And if I sent you US dollar coin in Mexico, you could go to your Coinbase account in Mexico, and Coinbase would exchange it to you for $0. And you could cash it out. You could just send yourself a bank transfer or wire transfer, whatever Coinbase allows. They don't charge for it. And you would have money that if I sent it from my Coinbase account to your Coinbase account and you turned it into USD and you took it out, we would literally have executed that entire transaction for $0. Now the reason is because, Coinbase is a part of a consortium that creates USDC, and so it can do it for super cheap. But the point is that like USDC, I could also do that outside of Coinbase. I could have it in my own wallet, not in the control of anyone, just in my own control. I could then send it over Polygon's network, for example, and you could then have USDC that we just paid 0.01 cents for. And now that person in Mexico holds USDC. They can go to Coinbase, they send it to their Coinbase account. They can go exchange it for cash for $0 and withdraw it. And so without even using like a centralized company, just using your own, like the network that exists distributed across the world, you could execute this transaction cross-border for less than a cent.
Okay, excellent. All right, so I cut you off, but let's continue.
Yeah. So turning back, so we've been talking about Bitcoin purely as money. And what a lot of people are going to point out is they're going to be like, but Bitcoin's terrible money. Why is it terrible money? Well, it's simple. It fluctuates massively in price all the time. And it still costs $1, $2, $3 to send it across the network, even if you want to spend 20 cents on something. And therefore, that is terrible for purposes of money. And the truth is, so is Ethereum. It's not as expensive as Bitcoin, but same concept. And so you could actually end up using another network like Polygon so that you don't pay that much. But there's another purpose that you can look at Bitcoin for, is not money, but instead a store of value. Now, what do we mean by a store of value? We as crypto people, we look at it as a competitor to gold. And now, the more accurate way of describing Bitcoin right now is not a store of value, but a speculative store of value is probably more accurate, because when it fluctuates as much as it does, to say it's the same thing as gold is not true. But when you actually look at Bitcoin and people tell me, should I buy Bitcoin? I'm not giving financial advice here. But what I will say, my answer to that is always, do you understand basic economics, yes or no? And if you understand basic economics, then the answer is actually pretty easy to that. Why? Well, because when Bitcoin was created, there is an open source code base that you can look at that says the maximum amount of Bitcoin that will ever exist is 21 million, and that can never be changed. You could see that is, we've got tons of people who have now reviewed that code base that cannot be changed. And given the fact that will not be changed, what you now have is you have this asset that has a fixed supply. And that fixed supply is 21 million. Now, without getting into like the details, the way effectively Bitcoin works is that technically there's about 19 million or so in supply, and it like increases over the next 100 years till it gets to 21 million. But you know it's never going to be above 21 million. And so if you know that, and then you know basic economics, how do you know whether the price of Bitcoin is going to go up or not? And the answer is, will there be more demand or will there not? And the thing that's been very clear since 2017, maybe since 2019, 2019 was a scary time when Bitcoin dropped to 3,000. But like since then, what's been very clear is there will only be an increasing demand for Bitcoin. And why is it that there'll only be an increasing demand for Bitcoin? It's simply because you've got an asset that everybody knows has a fixed supply. It is super easy to buy. It can be used for purposes such as money if you want. It can be stored at pretty much zero cost to you. It can be transferred at very low cost and with ease. Basically, what you just saw is all the attributes of gold, but better. And so when you look at that, you basically say, like, why wouldn't I buy this thing? And then it became very obvious this year to people, which was always obvious, but it became abundantly obvious when the US government said, oh, I will approve ETF, exchange traded funds, products on Bitcoin. And then suddenly what you see is all of these companies start buying a boatload of Bitcoin because their users want to hold, their customers want to hold these assets. And then what you get is one of the biggest financial institutions in the world, Fidelity, that puts out a report that says, we actually recommend that everybody holds between 1% and 3% of Bitcoin in their portfolios. It's pretty obvious at this point to me, and I think it's not going to stop, that you're just going to have more financial institutions that are going to say, yeah, we recommend that you hold a portion of this in your portfolio. And so what's going to happen to Bitcoin? Simple. Demand's going to continue to increase. We already know supply is fixed. So what happens to Bitcoin? And so like the analysis around Bitcoin, whether you believe it's a money and could be a money or not, or be a form of money or not, is not that hard, because you do know that it's probably actually a store of value that, while speculative, has been speculative with this shape to it. And that's not like a bad shape to speculate on. And you would expect that Bitcoin would continue to actually go up and down less with time. But nonetheless, you would expect that it'll continue to be volatile over some period of time until, honestly, enough people in the world hold it and the price doesn't go up and down anymore. So this was a long way of saying that, like, the original cryptocurrency really served two purposes, potentially money and potentially like a store of value. But frankly, there's so many cryptocurrencies that that's not what they all do. And we could talk about that if you want. But at least as a foundation, this is really kind of like the concept behind Bitcoin and why there's a lot of like desire and interest in Bitcoin.
Okay. Now, do you think Fidelity recommends or used to recommend holding gold?
I have not looked at it. But that being said, like financial institutions, like the financial advisors generally recommend like a diversified portfolio, and they don't usually recommend one portfolio. They basically go ahead, they do a questionnaire, and they say, hey, what's your risk tolerance and what are you looking for? And usually they give like a pretty diverse portfolio, and it usually includes things like equity, debt, some amount of REITs, and there's a global element to it from a diversity perspective. Usually I'd say commodities end up being what I would consider to be like an alternative asset. Usually they haven't really recommended them as much, but I think the difference with Bitcoin is the risk reward ratio on Bitcoin as a commodity is completely different from your typical commodity. And the cost of leaving Bitcoin out of your portfolio is so high potentially that it makes it different from other commodities, where the risk of leaving gold out of your portfolio is like an inflation hedge that isn't that impactful. Whereas if you put Bitcoin in your portfolio back in 2017, you're up something like 10,000% or something, or whatever it is, like a massive percentage. And if you put it back in, well, probably not 10,000%, but if you back 2015, you're definitely up like 10,000%. So the cost of not putting Bitcoin in your portfolio is extremely high compared to gold, for example.
Okay. Now, in my situation, I'm young, I'm 34. I am very active in real estate, as you know, which involves capital, it's very capital intensive. So I use my money. I have mortgages on properties. I'm regularly having to borrow, and then I'm funding renovations, down payments, etc. out of pocket. In this situation, I wouldn't imagine someone would recommend I hold gold. Nor do I want my money necessarily sitting in something as a store of value, right? I wouldn't see myself buying anything that's just to hold value when I'm actively using my capital. Do you see, I thought of this question before your argument about the missing out on the opportunity cost of not owning Bitcoin. But what do you think of that with, the way me being in real estate, being very active in real estate and having the ability to use my capital extensively in real estate? How do you feel about whether I should own Bitcoin as a store of value?
Yeah. So I never tell people whether it's right for them or not. The way that I think about this is a few fold. So first, everyone specializes, anyone who specializes in something should probably put most of their time and money into that something. I also think it's bad for anyone, no matter how confident you are in an asset class, to put all of your money into that asset class, at least past a certain age, right? I think at 34 years old, probably fine. You lose it all. It goes bad. Unlikely in real estate, obviously, but not really that big of a deal. You'll just accumulate it again. Obviously not ideal either. But there's a certain age where, and honestly probably getting close there, where it's okay, but there are other assets that return well, right? The reality is, if you had bought Bitcoin with the funds that you used in real estate, you would be 10x where any real estate person is at right now. Is just a reality. It's not deniable. But it would have been with significantly more risk than the risk that you've taken in your portfolio. And so with everything, it's a question of do you believe that it would make sense for you to have some level of diversification when it comes to what you're doing? And if you're so confident in the way that you're executing on real estate investments, then the answer is probably not. If you think that it's worthwhile to hold something different that has a lot of potential, and that has hedges, frankly, against a lot of massive global macro risks, including pain to the Canadian dollar, pain to the US dollar, holding something that is Bitcoin is massive hedge to the Canadian dollar massively tanking relative to the US dollar. Let's say for me, it's a huge hedge where the US dollar completely blows up, whether that's on a 1-year time frame, 5-year time frame, or 20-year time frame. If I'm holding Bitcoin, I'm not impacted by that. If anything, frankly, it makes my Bitcoin worth significantly more in the local dollars. And so I view it as very little kind of downside to holding a small portion in Bitcoin. But I will also say that we've only been talking about Bitcoin. And yes, you actually should expand beyond Bitcoin if you're talking about revenue generating assets.
You know what? Before we do, because I have some questions I want to ask more about using Bitcoin on this, and then we can approach how these answers might change for other crypto options. Sure. In Canada, we have something called the TFSA, tax-free savings account. I believe it's similar to your Roth IRA. You put after-tax dollars in, the money you take out of it is not taxed. And I believe if you were 18 by something like 2009, 2007, you can put 90-something thousand in it. I believe could be off by a little bit. Because it's not something you have to put money in every year. Your room expands every year, and so you could put it all in at once. And that way, the returns you make on that would be tax-free, any returns you make on that. And you can withdraw it. It doesn't need to wait for retirement. So some similarities to your Roth IRA, but I believe some more flexibility here as well. Now, obviously, it's a structured, retirement account type of thing. So you'll have to buy something traded. You were talking about Bitcoin ETFs or ETFs that were allowed. I imagine something like that would be able to be traded in a retirement account. Yep. Do you see that as hopefully a good use for someone who's got kind of, I could see that for myself. Let's say, okay, I want to diversify, and I can't directly buy real estate through my TFSA or a Roth IRA. Why don't I do that? Why don't I diversify and buy a crypto or Bitcoin ETF? And that way, if it performs well, the return I make in there is tax-free.
Are you a savvy real estate investor looking to maximize your profits? Well, if you're buying properties off the MLS, you're not making as much as you could. The most lucrative way to boost your bottom line is by acquiring investment properties off market. By buying privately off market, you're able to save tens of thousands. Now, the problem is finding off market properties is really hard and takes a lot of time, effort, and money to do. Bliss is your number one source, delivering exclusive deals that you will not find on the MLS directly to your inbox. Bliss's extensive network and insider connections gives you access to properties that are not publicly listed and at a discount. We've helped hundreds of investors across Ontario and BC source the right properties at the right time for their portfolio. Buying assignable purchase contracts through Bliss at a discount helps facilitate higher returns, lower competition, and deals that align perfectly with your investment goals. From start to finish, Bliss's world-class team of real estate professionals makes the process seamless for all investors. If you're ready to elevate your real estate investment strategy, visit us at offmarketbliss.ca to join our buyers list and start receiving exclusive off-market deals directly to your inbox. The most profitable opportunities await, and they're exclusive to you and our valued buyers list members. For your next project, check out Bliss, the go-to source for off-market deals.
Yeah.
What do you think?
Yeah, the answer is it's often viewed as a very desirable investment. People used to find ways before ETFs on how it was that they could hold Bitcoin through like interesting structures in retirement accounts. But to me, that again is just like you do an analysis of how you want your retirement portfolio to look. And when you can hold it if you desire and you're like, hey, Bitcoin would be good, then you actually have an opportunity to hold it. And I think that's a good thing. People should have a right to choose what they hold and understand like the risks associated with it. And so, yeah, holding it in if they consider like the risk to be appropriate for them, then it makes sense for them to hold it there.
Another question I have is obviously in real estate, one of the things I like most about real estate is because people consider it very good security. It's relatively easy to borrow against it. Relatively easy. You can borrow against it quite well at very reasonable rates. Is it possible, and we could get into other crypto about this, but is it possible to borrow against your Bitcoin? And how would that work, and what kind of rates would it cost you?
Yeah. So people have been allowing borrowing against Bitcoin for quite some time now. And the simple reason is because it's one of the best collaterals you could possibly ever want, because it is incredibly liquid and able to be sold immediately on a 24/7 basis, right? The crypto markets don't stop, unlike the stock markets. And so the way that it's typically worked is you put down a certain amount of Bitcoin collateral, maybe 70 to 80% of the value that, 120, 130% of the value that you want to borrow. And you can go ahead and borrow the asset. And essentially what will happen is if the Bitcoin drops below a certain value, they'll say, do you want to send me more Bitcoin? Or we'll just liquidate some of your Bitcoin and you continue to hold. But you don't need to liquidate the entire asset. You're literally just like, hey, you dropped below your margin requirements. Okay, I'll liquidate 5% of your Bitcoin. And so in a way, it's like a perfect form of collateral. Now, this is about to like enter a much more complex discussion, but I'll try to keep it simple, which is what we're talking about here is actually you send your Bitcoin to a person and they actually control that Bitcoin and they decide when they sell it or not. There's something in the crypto space that we refer to as DeFi, decentralized finance. It's an area where I've spent kind of a lot of time. And essentially what DeFi has done is it's replicated what exists in financial systems, but with smart contracts. So essentially like contracts on a blockchain that are automated instead of people. So there are some of these DeFi, refer them as DeFi protocols, or you could refer to them as DeFi applications, dApps, or decentralized applications. And one of them as an example that I'll give you is one that we call Compound, or another is called Aave. And what you would do is you would say, hey,
Compound or what?
Or Aave, AAVE.
AAVE. Okay.
Yep. And what you do is, let's say that you hold a certain amount of Ethereum, ETH. You can deposit that into the protocol. And so now what you're doing is you're actually deposited to like essentially what we refer to as a smart contract. Think of it as like a vault that is on this blockchain. So it's not a vault that I control. It's not a vault that anyone controls. It's a vault that these thousands of nodes, they all have on their computers. And it basically recognizes, oh, you have put 100,000 US ETH, Ethereum, into this vault. And what it has is it has like a calculation that is like in this contract that says if you've deposited a certain amount of Ethereum, then you can borrow 80% of that in any of these options. And it could be USDC that we talked about. It could be Matic. It could be a range of different cryptocurrencies that exist there. And you would go ahead and you would say, cool, now I'm going to pull, let's say, 60% of that from there. And what this protocol says is it says, hey, if there's ever a time where you put 80% of collateral in here, where the collateral does not cover at least 90% of the value, then anyone is allowed to come buy that collateral at a 3% discount. And what you have is you have thousands of bots that exist all the time, just bots on computers that are scanning this. They're like, hey, is anyone under collateralized? Is anyone under collateralized? And everyone under collateralized. And the second they see a position that's under collateralized, boom, they snap it up, and they get a 3% discount on it. And so effectively what you have here is a mechanism where with no people involved, I can drop my crypto into a contract. I can borrow against it. I can go use it anywhere I want. I can never pay this thing back because theoretically, as long as it doesn't get liquidated, nothing happens. Or if I just want to hold this and I'm okay taking a 3% loss on all of the assets that are in there, then all my assets will end up getting purchased at a 3% discount and they'll close. There'll never be an issue with me having not repaid my loan. Or if I say, hey, I'm good. I've finished using this asset for whatever I need. Okay, I'm going to go drop it back into this protocol. Now this contract will automatically unlock and say, cool, you can take your assets back out. You returned what you need. And I take my assets back out and I'm done. And so I can borrow on cryptocurrencies incredibly easily. There's examples of people borrowing to buy houses, by example. They'll drop a massive amount of ETH into the Aave. They'll borrow USDC. They now have USDC. They go to Coinbase, they exchange it for US dollars, and they pay to buy a house. And now what they have is they have a secured loan on this house. It's the security is not the house. The security is actually their ETH. And if they ever need to top up the ETH because it's the value of ETH dropped, for example, then they'll go and they'll top it up and throw some more ETH into it. Or more likely, because frankly, this is how crypto usually does, the price of ETH goes up and they literally never have to worry about paying it back for a very...
Well, and if anything, they could then borrow more. Is that correct?
Well, theoretically, they could go borrow on their house to go pay back the ETH that they borrowed as well.
So this is very interesting. What about like the interest rate? Is there what's the interest rate charged on something like this?
So I left this part out, but it's probably one of the most fascinating, is the interest rate is all done based off of supply and demand. So literally, it's just a axis like this that says we look at how much demand there is for this asset, as in how many people are borrowing out of this pool and how many people are dropping assets as collateral into this pool. And then interest rates automatically increase or decrease based off of how much demand there is. If more people are taking assets out, borrowing, and putting another collateral in, then the interest rate actually increases. If fewer people are actually putting it, or more collateral is going into the pool, then the interest rate actually decreases. Right now, like the interest rate's probably, it depends. Crypto's very hot right now. And so demand for these assets is massive. And so we've seen like interest rates go up to like 15%, super high. When we were in a bear market like a year ago, you could see crypto, you could borrow for like 1.5%, something of that nature. And so depending on
But
the market,
does your interest rate continually change, or is it based on when you started the contract?
so there's multiple different ways that you could do it. In Aave, you have the option. You have a fixed price interest rate, or you have a variable rate interest rate. The variable interest rate literally changes by block. So blockchains literally operate by block, not by time. And every time there's a new block, there's a new interest rate based off of the supply and demand. So it changes all the time. Great for short-term borrowing.
What were we talking? Every few seconds, every few minutes, every few days?
Every Ethereum's like every 12 seconds. Something like Polygon's like much shorter than that. So very like all the time changing.
Okay.
Which decreases the risk rate of you have that collateral there where you can make sure you can liquidate it on time as these blocks kind of go through. But the other option is you can actually borrow at a fixed rate. And essentially what it does is you can think of it as like hedging the price in the background is effectively what's happening when you borrow at a fixed rate on something like Aave. And now you can guarantee yourself fixed rate, and the rate's higher, probably for, I can't remember right now, but 3 to 5% higher at that fixed rate.
Okay. I think this is interesting. I think there's some, it makes me think a little bit how people try to sell whole life insurance. Not sure how much you've heard about, whole life insurance, and people talk about infinite banking and how you can, you pay into this whole life insurance and then you can borrow against your cash surrender value. It gives me I don't personally think whole life insurance is appropriate for most people. I think it's not a scam, but it's not, if you're investing in anything, you can do better. You could just pay for a universal life policy and not do that. But yeah, I mean, it's the same sales pitch, the infinite banking does work in this way. It's like, yeah, you can not only hold the crypto, but you know what? It's not just a store of value. I need to free up some cash and I don't want to sell it. Cool. I can borrow against it right now. I can put it in this vault and I have that flexibility to borrow against it.
And the benefit is you're not giving up the potential of that store of value during that time. Yes. Right. So if I had put ETH into a vault in 2017, right, at, I don't know, $75, I could be pulling it out today at $3,600. And I could have been borrowing against that the entire time.
And you would have been able to borrow against it as it changed. So when it was at $75, you were borrowing 80% of that, or, but when it became $1,000, you could borrow 80% of $1,000 as well, right? Is that?
Yep.
Yeah.
That's right.
Okay. That's nice. And yeah, it makes sense. You wouldn't want to, unless you're borrowing for a very short amount of time, you wouldn't want to borrow too high on it, because there are the fluctuations and you wouldn't want to risk too much of it being sold on the margin call. So that makes sense.
Exactly.
Okay. Now you were going to talk about, we kind of stuck mostly with Bitcoin here. You were going to tell me a bit about other options, other types of crypto that could be helpful or useful.
Yeah. So I think the interesting thing about Bitcoin, right, is that it really doesn't, the way people talk about it is not a revenue generating asset. Like, what is interesting about Bitcoin? A lot of people, especially in real estate, look at that and say, this sucks compared to a rental that I could hold. But when you start going beyond Bitcoin, this becomes less true. So Ethereum is a good example of this. So Bitcoin uses, to secure the network, it uses something referred to as proof of stake. Essentially, you run mathematical calculus, and through that cryptography, you've secured the network. Ethereum used to run on proof of work, and it's changed to proof of stake, which is what Polygon POS uses as well. And instead, it uses what we'll call like a crypto economic guarantee. It's basically guaranteed that people will not act bad based off of some economic security. And the economic security is that when anyone is securing a proof of stake network like Ethereum, they are putting at stake, i.e. putting at risk, a certain amount of crypto. So if you want to secure the Ethereum network, what you're going to do is you're going to drop a certain amount of Ethereum with what we refer to as a validator. These are the folks that verify. They're the ones that hold that ledger across all the way. And they're going to verify that every transaction is valid based off of the valid ledger that they have. To do that, they need to stake a certain amount of cryptocurrency to say, if you are a bad actor, you can be stripped of your stake. So we're going to ensure that you are a good actor by you putting money at risk, because you would just lose your money if you tried to be a bad actor. So this ensures like good conduct, or protects the network in case of bad conduct. But when people do that, what we also do is we say, okay, we're going to reward you for doing that. And so I'm going to simplify Ethereum, and then I'll tell you what I'm really missing when I say this, but I'll explain. Validators receive the fees and rewards from the network on Ethereum. So if I own, the ETH that I do own, I stake it, and I generate 5% on that ETH at all times. And every
5% per annum.
5% per annum. It goes up and down, right? Because it's based on the price of ETH at that time. It's also based on how many people are staking, how much the network's used. It fluctuates. Frankly, it's a question of like how desirable is the network, just like it's a question of how desirable is your home based off how much like rent you can actually demand and how full you can have it. It's not a dissimilar concept in that if the network is in demand and used, that percentage is going to be higher than if it's not. And so I can actually at all times hold my ETH and continue to earn 5% on it. Now, Ethereum is actually a very safe asset to hold, frankly, relatively speaking, in the crypto space. I've got other assets where I can stake them to secure a network, and I'm earning 20% on that. Obviously, that's a riskier asset, more likely to go kind of up and down or even just down, but I can earn 20% on it. The point is that it actually becomes a revenue-generating asset for you. There's even one network, and I won't name which one, that actually pays you USDC, cold hard cash. Like literally you're earning right now, I think 23% for securing the network in cold hard cash a year. And so when people in kind of real estate and in other areas say like crypto is not a revenue generating asset, well, what they really mean is Bitcoin is not a revenue generating asset. And frankly, I think that's completely fine. I think Bitcoin does plenty fine for a portfolio and for its uses without generating any revenue. There's a whole bunch of other assets that actually do generate revenue that effectively, if you know what you're doing, you can determine, like you could form views on how in demand this network's going to be and whether those fees are going to continue to be generated or not.
Okay. Now, what risks do you take by staking? Like, what's the difference in risk? Let's say we want to hold Ethereum. What's the difference in risk between just holding it in your wallet versus staking it?
Yeah. I'm going to leave the exotic ways of staking it aside and just say you find a validator that you trust, or you run your own validator and you are going to stake. The answer is like ridiculous, like insanely low, like the 0.000000001% risk associated with anything happen to that asset. The risk that you're actually taking, right, is the price of ETH going up or down, rather than anything associated with like actually losing those funds. Now, there are much more aggressive things you can do with your crypto that actually does put it at risk. But in this case, staking, you're not really putting it at risk.
So it's not similar to, like, I don't know, if you stake it, that somebody could be a bad actor and then your money somehow gets lost from that. No. Okay. All right. Good to know.
Now, what I was explaining, to be clear, what I was explaining earlier, when you talk about like DeFi and stuff, now you're actually using kind of applications that have been created where people do get money stolen from them all the time. I mean, crypto's like, as much as it is, in my opinion, like the area that actually gives us the brightest future when it comes to security and potential, it's also the area that has the most scams you could possibly imagine right now. That's just like a reality of where crypto is. And everyone comes to areas where there's a lot of opportunity.
I think the start of hesitation.
That is like, that's the hesitation for a lot. And that's why I mentioned it, because there's a difference between, I'm just going to hold Bitcoin. And it's like, okay, like you can't possibly think Bitcoin's a scam now. I mean, some people probably do, but like realistically you can't. You hold Ether. I'm pretty hard to imagine how Ether is a scam. But there are new cryptocurrencies that could create, I mean, I'm guessing there's 100,000 cryptocurrencies now. I could create a cryptocurrency in like 5 minutes. And I could completely scam you by telling you that it's something good. But like the safest ones and the biggest names, you're not going to get like scammed out of it. But similarly, if you take your ETH and you go to some no-name place and you say like, we were talking about DeFi protocols, right? Like Compound and Aave. Now go take that asset and go put it in no-name XYZ to do the same thing. The likelihood that that is a scam or that they have a bug in their software that results in losses is extremely high. And so just don't do it. But that has nothing to do with like crypto as a whole. It has to do with like one area of crypto or one, frankly, actor in crypto. And you just need to be like vigilant of that in any kind of like new area. And frankly, it's one really important thing for crypto is that like we grow out of these scams, that you get more and more real use cases, more and more real benefits, and fewer scams.
Okay, well, I do want to talk a little bit about those use cases. First of all, in real estate, you hear people talking about tokenization of real estate, and how people are selling tokenization of properties. Do you see a value to that? Do you see that part of crypto's future? Tokenizing real estate, is that a useful thing?
Yeah. So I smile because back in 2018, when the crypto market like crashed in late 2018, I spent like a good year. I don't even know if you know this, but working on tokenizing real estate and REITs. And the truth is, we were very, very early in those days. And the way that you need to think about like tokenization in crypto, we refer to them as just real world assets. Probably better to say off-chain assets because like crypto is a real world asset too. But nonetheless, we call them real world assets. Is to say, okay, I'm going to get away from like the original reason why crypto was created, right? Crypto was created so that like you could control your own assets. You don't have to trust anybody. Okay, that's not going to exist with real estate. Like you've got a real asset that's sitting there. Like you are going to have to, there's a real seller on the other side. Like you're going to have to trust somebody. And so those kind of things go away. So then you have to start looking and you say, okay, are there benefits that are separate from what crypto was invented for with tokenizing a real world asset? And generally the things that people point to, and you can like pick these apart like one by one, is more efficient transfer of that asset. Okay, so that's one that I always say yes, but, i.e., could you, if you tokenize that real estate, could you actually transfer it faster? Yes, if the government moved records and legally you actually allowed for transfer of real estate on chain. There's actually, back in 2017, I worked with somebody who was actually working with one of the county records offices to actually get them to like move deeds on chain and stuff like that. In the States, I can't remember how it is in Canada, but in the States, like literally every single county has its own process. So like imagining that you're going to get to a point where you can trade real estate efficiently on chain in a way that actually truly transfers title is like highly unlikely. Leave aside all the peculiarities with like how you actually achieve those transfers from a legal perspective. And so the answer is theoretically though, if you fast forward some period of time, you get the government on board, you can actually be like substantially more efficient in actually transferring those assets. And so people have pretty much for the time being given up on transferring an asset as a whole for the exact reasons I just said. Instead, what they talk about is they say, okay, but there's the benefit of potentially fractionalizing these assets. And I look at that and I always say, hey, if I'm going to be objective about this, that's not actually real in the sense that I can fractionalize a piece of property right now if I want. I don't need like tokenization to do that. But there are some benefits once you dig in deeper. Once you've fractionalized it, what you've probably done is you put your asset, your real estate, into an LLC, presumably. You've then tokenized that LLC, and you've created an LLC agreement or the equivalent in Canada. Or there's no LLC agreement, where you basically say, hey, a transfer of this LLC interest is valid if this token is transferred. And at that point in time, you can actually have a way easier mechanism of actually transferring a fractional interest in a piece of property. You could create exchanges that allow for the transfer of these assets, and you could have the entire markets that flourish in fractionalized kind of interests that can be transferred. When you dig into that one step deeper, though, you realize, well, there's actually issues because I actually need disclosures. I'm not just going to like randomly buy a fractional piece of real estate without having dug into it somewhat. And then you start realizing, okay, well, how useful is it actually if that is going to be the case? And then you start talking about, okay, well, how do you make disclosures actually apparent? You start needing to digitize certain information about the property. You could still never get information because you have no idea if somebody just broke down a wall like 1 hour before you bought the property, and so on and so forth. So there's still like downsides to it, but you start getting closer to seeing like a real benefit. You're like, oh, actually, we could benefit from this tokenization. There's just some like hurdles that we need to get through that. There's other things, right? So like if you tokenize it, then you could go ahead and sell like interest in it in a much easier way. Just like a simple like primary sale. You're like, hey, I'm going to tokenize this and create a fractional interest. I'm just going to sell like interest of that right up front. And I could do that for USDC. So super simple, like crypto for crypto transfer. Okay, that's something that could be a benefit. I think the last thing that I'll say on where there's real benefits is transparency. You could see who the owners are at all times. Like everything, people think crypto is anonymous. It's like a complete misunderstanding of crypto. Crypto is not anonymous. It's the opposite of anonymity. You could see everything in crypto. And so the benefit here is you can actually see like who are the owners, and by who, it's not the name of the person, it's a wallet address that you can associate with people if you want. You could see who owns it, and then what you could do is you could tell somebody, for example, hey, we require you to pay rent in USDC, and please send it to this address. And what would happen is that address would automatically stream the crypto out to all of the owners of the LLC interests. And so on a monthly basis, you would do nothing. Rent would just get sent to that address. It would get streamed out to all the owners, and they would own it right away. So I would say the payment mechanisms that are inherent in crypto and exist on crypto rails are what tokenization allows, because they allow for a recognition of who actually owns that asset on chain, and therefore the payments can be streamed to them automatically on chain. I think that when we really like evolve a lot further into like tokenization, I think we'll get to a point where it'll make more and more sense to put some of that on chain. Not everything. People say like tokenize everything. I think that's BS. But when you get to like huge multifamily properties, people get more accustomed to actually using crypto. They actually know how to use it. Suddenly being like, hey, just like stream, like pay over here, and then you could stream payments out to people on certain schedules. You could stream them out to vendors so you don't have to like so many things that you could like simplify, because frankly, blockchains allow for much better payment mechanisms than standard payment rails.
Okay. Well, we're almost out of time. I did want to ask you two questions. First is, how or why is Polygon different than its competition? And two is, and let's keep these short because I know you're almost out of time, but what do you see the future? Where are things moving with crypto? What should people be kind of expecting for the future, or what should they be looking forward to?
Yeah. So on the Polygon side of things, I think trying to leave complexity out of it, really what we've done is we're very focused on a certain type of technology that's going to advance the space that we refer to as ZK technology. So this is zero knowledge technology. It's basically the ability to cryptographically prove a piece of information without ever revealing that piece of information. And in the context of making blockchains like faster, what you can do is you can take a ton of transactions, and instead of pushing them through to Ethereum every single time, what you can do is you can bundle them up into one thing that we refer to as a cryptographic proof. And you could say, I can prove all of the information in this bundle without debundling it and putting it on Ethereum. And what on top of that, what I can do is I can then take other bundles and I can bundle them up together as well through these proofs, to a point where you continue to bundle these proofs up, that when you get like millions of transactions, instead of paying millions of dollars to Ethereum, a million of ETH to Ethereum, effectively what you're doing is saying, no, I'm going to amortize all those costs, because creating a new proof is actually really cheap. And then we're going to put that all on Ethereum. And so you still get the guarantees of the security that Ethereum provides through these cryptographic proofs. This is like the core kind of innovative technology that we are working on, that we have like leaders throughout the world working on. And I think that like nobody else has that much talent in ZK technology as we do. And I think that really differentiates us. In terms of the future of crypto, I think crypto is such a big area that it's really hard to kind of lay out everything that it's going to do. But I think like the few areas that are worth paying attention to is like Bitcoin's always worth paying attention to because frankly, it's Bitcoin. But I would also say that like the other areas are probably just payments. Like if you want to know a real use case for blockchain that is already proven, just many people don't realize it, it's payments. If you ever want to make a payment in a faster, cheaper way, just go check out crypto and learn which way it is that you can do that. But there's many different cryptocurrencies in which you can do that. And at a minimum, the blockchain rails allows for those to be very, very cheap. And then I'd say like the third one, leaving aside like cool things like gaming that you can do on chain and own your own assets and things like that. I think the other obvious one is like DeFi. Again, it's finance related. These naturally fit in with crypto. But the idea that you can exchange assets, borrow assets, lend assets, without ever needing to rely on another person, and that you can do that 24/7 in real time is something that like, honestly, the world's just not used to. And as we get that to be safer, more reliable, I think more and more people are going to move into like the DeFi ecosystem. And I think it's something that'll end up being like super useful to the world in general.
Awesome, Marc. This was amazing. I'm very proud to have you as my brother, and very happy to have you on the show. If people want to follow you or Polygon Labs, where can they do that?
Yeah, so crypto lives on Twitter, or now X. And so you can go follow me at 0xmarkb, and that is my X handle, or 0x Polygon if you want to know more about Polygon. It's probably the best place.
Okay.
But thanks for having me on. This was so much fun. And maybe we'll do it some other time and dig deeper into it as kind of real estate folks start to use crypto more.
All right. That would be awesome. Thanks, Marc. Take care.
All right, cool. See ya.